Welcome to a special edition of the Masters of Risk podcast, coming to you from the 2026 Definitive Risk Conference hosted by S&P Global. This event brings together leaders from across markets, finance, and risk management to explore how risk is being understood, measured, and managed in an increasingly complex global environment. For this episode, we recorded a series of conversations with senior practitioners spanning valuation, derivatives, private credit, asset management, and non-financial risk. Each discussion offers a distinct vantage point on today's risk landscape, how uncertainty shows up in different corners of the market, and how firms are adapting in real time. Individually, these are focused conversations. Taken together, they tell a broader story about how risk is evolving across asset classes, business models, and market cycles. This is Masters of Risk. Let's get started. Today, I'm joined by Lionel Jolie, partner and head of credit at Lehman Company. Lionel helped launch the firm's credit strategy and brings more than 2 decades of experience investing across the credit spectrum, from performing credit through stressed and distressed opportunities. Prior to joining Lehman, he managed a multi-billion-dollar portfolio of corporate loans and bonds, giving him a frontline perspective on credit markets across cycles. Lionel, thank you for joining the podcast today.
Thank you for having me.
And for our audience who doesn't know about your firm, can you talk a little bit about what your firm does, what spaces you invest in?
Yes, no, of course. We're a $9 billion alternative asset management company, spread across private equity and private credit. Now, what's really specific about Lehman is we are sector focused, and we invest in 4 sectors specifically, which are aerospace, defense and government, industrials and infrastructure, and maritime and environmental.
That's very interesting to see. And I guess, so you're in the private credit and private equity space. So are you making loans directly, or are you acquiring loans that already exist? Or
most of our activity is actually a secondary activity. So we're effectively providing liquidity to lenders who need to raise cash quickly, quietly. So they can be, and we're agnostic between the public and the private side of the market. So we will buy loans from CLOs on the public side, from high yield bond managers, and on the other side, on the private side, we will source from direct lenders, from BDCs, etc.
Oh, absolutely. And speaking of BDCs and direct lenders, there are a lot of funds now who need your liquidity. So you guys are actually kind of like saving the market now. So I guess, can you talk a little bit about your experience in terms of, I guess, the frontline investors or the original direct lenders who need to actually who need that liquidity? So can you talk about the names that you have to purchase? Sometimes they may be distressed loans at this point. So how do you guys stomach that risk, and how do you assess that risk?
No, that's a great question. And really what's happening at the moment is that the BDC industry grew quite significantly. I mean, BDC assets went from 100 billion 5 years ago to 600 billion this year. And obviously, as most of you probably know, BDCs have been facing a wave of redemption requests. So many of them have put up the gates, limiting distributions to 5% a quarter. Now, it means that, it's changing their risk profile and their liquidity profile. So what it does not mean, and I think what the disconnect is between the headlines and the reality is, there's a bit of a perception that BDCs are forced into a fire sale, which is not the case. They have time to effectively sell their assets. So it's going to play out over a long period of time, probably many quarters. However, it still means that they are not growing their asset base, and they are still leaking some assets. And on top of it, as it's been widely reported, some of their banks that are providing leverage to these BDCs are also tightening the terms of these loans, particularly around software exposure. So what it means is that the BDC managers, some of them, are looking for liquidity, looking to raise cash. The obvious way would be to actually sell the software exposure, the software loans that have been kind of at the center of the problem, or the perception problem. But obviously, there's little demand at the moment and little appetite for these software loans. So you are now in a position, if you're a BDC manager, and if you need to raise cash, you're effectively selling what you can, not necessarily what you want. And so it means that you're starting to sell loans that are not necessarily in the software sector or in the building product sectors, which are more stressed, and you're starting to sell in sectors like ours, where effectively we're starting to see some strong assets that we know very well, good companies, but again, that BDC managers will sell because they need to raise this cash and they need to raise it quickly.
Absolutely. And I envision that you guys are mostly in the leveraged loan space. So you're dealing with credits that are, B minus, triple C plus. So clearly in that speculative side of the credit spectrum. And the way S&P defines these companies who are B minus is that they're vulnerable to economic conditions, right? And the success of them are contingent on economic conditions, being healthy and staying positive. So what I'm interested in learning about is there's government expenditures in terms of deciding whether to spend 1.1 trillion in aerospace and defense or 1.5 trillion. So I'm interested to see how much of the success of these aerospace and defense loans are contingent on government spending.
To your first point about the leverage and the ratings, obviously the syndicated loan market and the direct loan market tend to be markets that are focused on levered companies. So to your point, they have less flexibility and they are more susceptible to changes in the macro environment. On top of it, I mean, many of these companies are companies that are very sensitive to changes in rate markets, because what we're seeing is you had a lot of loans that were issued in 2021, early 2022, when rates were close to zero, with very levered balance sheet. And obviously rates have grown quite a bit over the past few years. A lot of these companies were hoping that rates were going back to zero or close to zero. It has not happened. If anything, now people are discussing a potential rate hike again. And so what it means is that these companies have kind of spent the past few years using a lot of their liquidity, and some of them are finding themselves kind of at the end of the liquidity line. And so it's creating stress from that perspective. So that's on a macro and for the overall market. Now, for us, again, we're focused on sectors that are fortunately sectors that have a lot of tailwinds at the moment. I mean, whether it's aerospace, there's a shortage of aircraft in the world, there's a shortage of engines. And so there's quite a bit of demand actually for additional capacity and for the products that many of the companies in the aerospace sector are producing. And then on the defense side, to your point, we have an administration that is looking to effectively grow defense spending from $1 trillion to potentially $1.5 trillion. I mean, we'll have to see if it happens. We don't know. Nobody knows exactly what the final number will be, but it's clear that it's trending higher, which obviously is a strong benefit and effectively a strong support for a lot of the companies in our space.
Now, you mentioned these companies are highly levered, right? So we're probably talking about debt to EBITDA that's greater than 5x, interest coverage ratios that might be hovering around 1x, right? So what type of, I guess, credit risk metrics or credit metrics do you rely on to decide whether or not to purchase these secondary loans?
No, that's a great question. I mean, look, we pay a lot of attention to the liquidity position of the company. How much is left? Because again, we're talking about companies that have typically been using a lot of their liquidity over the past few years, and companies that may or may not be free cash flow positive. So what's their liquidity position? How does the outlook look from a liquidity standpoint? So meaning, are they free cash flow positive? Can they stand on their own legs? Or effectively, are you starting, and associated with it, have they continued to invest over the past few years in their actual industrial capabilities? We see a lot of companies today that effectively, because of the stress on their liquidity, have been cutting back on investment, on R&D, on CapEx. Now, it works potentially for a year or two, but then you start paying the price effectively, and it starts showing up in weaker growth, potentially weaker margins. And so we're, the key is to really differentiate between the companies that are now in a position that's kind of the death spiral, where effectively, because of the underinvestment they've made over the years, they're going to find themselves in a precarious position that's going to effectively destroy the enterprise value. And on the other end, companies that again, I've been able to probably cut back on spending, but I've still managed to invest in their business and are positioned for the growth, particularly in the sectors that we're discussing here.
Now, so you're in the aerospace and defense space. There was a notable airline that went bankrupt a few weeks ago. It's Spirit Airlines. What's interesting is, I took a couple flights as a student pilot, and my son is interested in being a pilot as well. And what we learned was that Spirit Airlines actually has one of the best pilot training programs. It's actually very tough to go through the Spirit pilot program, but that doesn't have to do with its financials, right? So there's operational risk there essentially. So I guess my question is, in terms of aerospace, how much does operational risk play in terms of risk?
No, it's about, you're completely right. It's about positioning on these companies, being in the right space at the right time. So, I mentioned the tailwinds to the aerospace industry. I mean, as I mentioned, you have a shortage of aircraft, you have a shortage of engines, but even within these subsectors, you want to pick the right spots. You want to be where the worst bottlenecks are at the moment. You want to find yourself also in positions that are more resilient. You want to look for businesses that effectively have more real assets, hard assets with long life that effectively protect your downside. So you're looking at kind of the trends to make sure that you have potentially some growth in the near term or the intermediate term for these companies. But also, in the end, we are credit investors, and any credit investor should be first and foremost focused on the downside protection. And in the end, your protection will be your assets. I mean, you talked about Spirit. We're not involved with Spirit, but Spirit had great pilots. They also used to have a great fleet of aircraft. They had a very young fleet. Pretty much all the aircrafts were the same. So you could switch your pilots from one plane to the other very quickly, very efficiently, which allowed their business model to thrive for a while. Now, the problem is, over the years, they started burning more and more cash. They started effectively selling their real assets, their best assets, which were their planes, against cash to fund their operating losses and their debt. And effectively, they're finding themselves in a position now where, or a few months ago, they found themselves in a position where they did not have any assets anymore. Pretty much all the planes and engines had been sold or transferred to others. And so they went from being an asset-heavy company to an asset-light company in bankruptcy, and that's partly why they struggled to effectively find a way out of the bankruptcy, particularly since it was a second bankruptcy. That's why effectively they liquidated the company and the assets. So the key is really, having a path out and really thinking about inflection points for these companies, particularly if the macro trends are supportive, but also always thinking about your downside, and particularly your expressed in terms of hard assets, scarcity of your assets, and honestly, the last piece being the management team, and having a management team that's experienced and will be good steward of your capital.
Sure, absolutely. Making sure they have sound fiscal policy, right? Many of the B- and triple C plus companies I looked at, or triple C, in terms of liquidity position, they depleted their cash, like you mentioned. There wasn't a lot of headroom in terms of the revolvers, for example. So they drew a lot on their revolvers, and oftentimes the private equity sponsor will have to come in and contribute capital. So how often are the private equity sponsors now contributing capital? Are they willing to do that to help the company? And then also, I've seen a lot of transactions where there were amend to extend. And are we seeing that now in 2026?
So in the old days, the main source of liquidity was the sponsor. Completely right. Now it has changed completely. Some sponsors will still help with liquidity, but what we've seen over the past few years is more and more liability management exercises, the LMEs. And effectively what it means is that now the sponsors are relying on the debt holders, the lenders, to figure out a way to extend the runway. And what we've seen is a lot of non-pro rata LME activity, where a majority group of lenders that will own 50.1% of the loan will effectively take a better position at the table than the remaining 49.9%. Now, the problem with these transactions is that first, we talked about Spirit and we talked about operational excellence. Well, if you're doing an LME, you're not changing anything to the operating activities of the business. You're not fixing what was probably the first problem, which was an operating issue. So that's the first thing. You're not touching it. Second thing is you're not really growing the value of the company. You're just redistributing the stack. And if you're on the wrong side of the 50%, you might find yourself subordinated with a much lower recovery. Now, from the sponsor perspective, it's okay because many of these LMEs are done with a super senior tranche that comes on top of everybody with new money. And so the sponsor, the sponsors used to inject equity at the bottom. Now, effectively, they're relying on the lenders to come in at the top with new debt, which effectively just will just push lower the rest of the capital structure. So for the sponsor, it's a nice win because you're extending your runway without having to effectively come up with liquidity. So you're keeping your options open. Now the problem we've seen is, experience shows that most of these enemies actually end up failing. So you solve the problem for a short period of time, and then a year later, you end up in bankruptcy. The problem of the situation is once you're in bankruptcy, particularly if you were in a minority group, your recovery, you've been layered by so much additional debt that your recovery tends to be de minimis.
Wow. Now, I have a question around, I guess I'll call it maturity risk. So the loans that you guys are purchasing, the loans I looked at were typically 5-year term loans, 7-year term loans. At what year, do you guys acquire that loan? And how much time do you have until you're worried about refinancing risk, for example? And as you mentioned, many companies who are refinancing now, they're refinancing at a higher rate, right? And if your interest coverage ratio was already low to begin with, how are you going to service that? So I'm just curious about the maturity risk.
No, and that's why, by the way, that's why we're seeing more and more peak transactions, where effectively, with the old capital structure that might be a SOFR plus 400 basis points, a loan that's coming to maturity, the sponsor or the company manages to refinance, but effectively refinances at a higher rate, let's say an S plus 600 or S plus 650, but the company cannot support the additional debt load. So what we've seen, particularly on the direct lending side of the market, the private side of the market, is more and more new issues, brand new loans that are effectively peak loans. Which we did not see in the past. We used to see some stressed or distressed loans that would turn into peak as part of the restructuring, but day one peak loans were kind of unusual, and it's not the case anymore. So sponsors and companies are managing their liquidity that way. Now, to the first part of your question about us, look, most loans, to your point, most loans are 6-7 years. We tend to come in, we're secondary buyers, as I mentioned. So we will come in to the life of a loan or bond 3-4 years after it was issued. So typically it will have a remaining life of 2 or 3 years. The key to your point is really to figure out, is it a business that needs to exist? Is it a business that has real assets, scarce assets that have real value, that somebody else, let's say a direct lender or the syndicated lenders or the high yield bondholders will effectively find attractive a year and a half, 2 years from now, and will look to refinance. What we're seeing in the market, even though there have been a lot of headlines around direct lending, there's still some liquidity in the market, and there's still appetite particularly from non-BDC direct lenders to effectively finance good companies and with strong assets.
So when you purchase these loans, clearly they're illiquid. So I'm assuming that there's wide bid-ask spreads. How do you guys, I guess, manage that in terms of trading? And what does your liquidity look like if you need to exit a loan?
No, so we're agnostic between public and private. So the public side is liquid. The private side, to your point, there's limited price visibility because it's not a trading market, even though it is changing. So when you come in and you buy a direct loan in the secondary market, you really have to think about your intrinsic fundamental value. And then you also have to bake in effectively the price of illiquidity, to your point. And I would say on top of it, you also have to include, the motivation of the seller, understand why people are selling. In many cases, the sellers are structural sellers. They are selling because the end of their fund life because they're too levered, they need to raise cash, etc. And so they are somewhat highly motivated or forced sellers. And when you're in their shoes, price become kind of secondary. But having said that, we are seeing growing liquidity in the secondary direct lending market. Some of the banks have started to trade actually direct loans. It took a while. There were different tries. It seems that it's finally starting to pick up, particularly I think with selling demand from BDCs, and the volume of loans has definitely picked up quite nicely, particularly over the past 2 or 3 years.
What's interesting now, especially in the fixed income space, the long end of the curve is starting to go up, right? But what I'm seeing in terms of high yield, spreads are actually pretty narrow and they're staying narrow. So I'm curious to get your take in terms of why the spreads are so narrow at this point.
So you're right. I mean, the high yield spread, the high yield option adjusted spread at the moment is around 260 basis points. Look, that's pretty close to the all-time tights for the high yield market. So you're really not getting paid much to own high yield in terms of spread. Now, the reason there is still appetite and there's still money coming into high yield is from an all-in yield perspective, the yield still looks attractive because, to your point, the yield on a high yield bond is effectively your spread plus the rate component. And if rates widen, at least for now, people are ready to take lower spreads because the overall yield remains attractive. Now, what's interesting as well in the market is, I think there's a bit of a bifurcation between larger liquid capital structures that everybody wants to go after, and people are ready not to get paid much in terms of spread, as you mentioned, which is really what we're seeing in the high yield market. There's a chase after large liquid benchmark names that trade extremely tight. So the higher end of the market is very well populated and sought after. However, below that, you're starting to see a real dispersion with a lot of orphan capital structures, where effectively the CLOs, the traditional lenders, the traditional bondholders have kind of sold their exposure or kept their exposure, but can't really get out easily. And as a result, we're seeing, if you look at the overall market, there's very little volatility, but actually below the surface, there's quite a bit of cross currents and quite a bit of intraday volatility in some of these names.
Now, who's your typical investor? Is it large institutions like an endowment fund or a pension fund? Or I'm just curious because your space is highly illiquid, right? So it has to be some type of institution who can stomach that illiquidity.
Yes, and again, I mean, we're agnostic between public and private. So we have a good portion of the portfolio that's actually on the public side, syndicated loans, high yield. That gives us liquidity. And then we effectively have the direct loans that, to your point, are less liquid by nature. So yes, we have an investor base that effectively is very well diversified with a lot of pensions and institutions that effectively can take in liquidity. But again, the underlying portfolio is actually not a pure direct lending portfolio.
Absolutely. And I'm asking that because what I'm seeing now, it's especially around the ETF space, right? There are more thematic ETFs, and one of them I'm seeing is the private credit ETFs, right? So fundamentally, what I'm seeing is you're taking an illiquid asset class and trying to make it a liquid investment vehicle, right? And it seems counterintuitive, right? I'm just curious to get your sense in terms of a private credit ETF and that existence.
Look, I mean, we've seen this play out with some of the BDCs. Particularly with the non-publicly traded, the perpetual BDCs. So historically, direct lending was working very well because, to your point, you had illiquid assets, but you had illiquid fund structure that were basically drawdown fund structure. And so you had a match in terms of duration of assets and liabilities. Now, enter the perpetual BDCs. They kept the same assets, so illiquid assets, but now they introduced some liquidity on the fund structure because basically investors are able or are supposed to be able to redeem a portion of their capital every quarter. It worked very well on the way up, and then we've seen this year that it becomes more challenging once you're hitting a period of volatility, particularly if everybody wants to take the money out at the same time, because you can't sell your assets fast enough, and you probably don't want to sell these assets. I mean, you don't want to go into a fire sale. And so the result is we've seen many of the perpetual BDCs basically raise the gates and say, well, sorry, we'll only redeem or allow you to redeem 5% per quarter. The ETF is kind of the next step. So on paper, it's interesting, it's attractive, it creates liquidity. I think the question will really be, what kind of assets do they have on the ETF side? Look, are they primarily large capital structure, investment grade private assets, or do you start going lower and effectively introduce really liquidity in these assets, which effectively would introduce a real mismatch in duration between assets and liabilities?
Now, the pressure that BDCs are seeing now, do you think that's contained at this point, or do you think it could be an iceberg effect where we're seeing the tip of the iceberg and potentially there's a blow up in the private credit space that's contagion rather than being contained?
I think some of it is perception.
Okay.
And the perception is very negative at the moment. I mean, look, the publicly traded BDCs, some of them trade at a 30 to 40% discount to NAV. So the public market tells you that they don't believe the NAV. Might be right, might be wrong, but there's a perception issue. And the consequence is that we're seeing very large redemption requests. We started to see them in the fourth quarter. We saw them at March 31st. We'll see what happens in June, but most likely we will have another round of pretty negative headlines with large redemption requests. But again, it does not mean you might have a 50% redemption. Does not matter. The gate is at 5%. So you will have, if you're an investor, you will have to wait for a long time before getting your cash back. And what it does is it serves as somewhat of a stabilization mechanism for the BDC industry, where they can effectively spread out the redemption over a longer time. So the perception that, so there is a perception issue, but the perception that things are really collapsing is not correct either. There is time. And look, I mean, I think the real question will also be that, is it just an isolated event to the BDCs, or does it spread out to the broader direct lending community? Again, it's going to take time for it to happen, even if it does happen, because most of the other direct lenders have fund structures that are that are long-term fund structures and that are more illiquid, that effectively match their assets. So there is, I mean, we're seeing definitely some changes in behavior in terms of deployment by BDCs. I mean, it has come down quite a bit because they're focused on managing their own liquidity, or for the publicly traded BDCs on buying back their own shares. If they're trading at a big discount to NAV, they might as well just use their cash to buy back their shares instead of deploying. So there is definitely a pullback in terms of investment activities by the BDCs. We'll have to see how long it lasts and what impact it really has on the rest of the direct lending community.
I want to take a step back and ask your thoughts on the current macroeconomic backdrop. So we're seeing equities at all-time highs. A lot of that's being driven by capital expenditures. I talked about the long end of the curve increasing dramatically. Crude oil prices are going through the roof because of the Middle East war. Even though that the forward curve it looks like the price per barrel of oil might drop by December, but that is putting pressure on the consumers' pockets. Inflation looks like it could be ticking up again, and because of that, the Federal Reserve can raise interest rates. So there seems like there's a lot at play here, right? And I'm just curious to get your thoughts on what we're currently seeing in the macroeconomic environment.
Yes, I mean, there are a lot of moving parts, to your point. And look, we're worried about the consumer. Your point, the consumer is directly impacted by higher oil prices, higher food prices. Look, we went through a period in 2022, 2023 of heightened inflation. And I think everybody thought it was behind us. And now the whole investment community was kind of waiting for rates to come back down, for the Fed to cut and keep on cutting, and it's not happening. Now, again, we're talking about potential rate hikes. It's true that financial markets are not showing the real signs of stress yet, but we are concern of the consumer, you're kind of seeing it also around the housing market. And by the way, if you look at credit, I mean, the building product space is trading at pretty distressed level overall. So there are definitely pockets where you're already starting to see the stress. For us, it's a bit different. That's partly why we don't invest in industries that are consumer facing. We have industries that actually, are in an environment where the outlook looks pretty good. And more important, whenever we underwrite a credit, we obviously stress test the credit quite a bit.
Sure.
Even if we don't have a direct impact, do we have an indirect impact if something happens with oil, if something happens with the consumer, etc., or some regulatory changes? It's all about stress testing your investment, being comfortable with the enterprise values, being comfortable with the potential downside, and understanding that you're buying it at a price and a creation valuation that effectively protects you on the downside.
No, absolutely. And it seems like just a couple of years ago, the Fed was cutting rates and we were concerned about whether or not there would be a soft landing, a hard landing. And it seems like that language no longer exists, right?
We did not land.
Right. Yeah. No landing, right? Going back to the Spirit and Airlines example, right? I guess for my last question, what risk concerns you the most the next 12 to 18 months from now?
I mean, echoing your prior question, it's probably the consumer, the state of the consumer and the transmission mechanism to the consumer. Look, nobody knows what will happen with the situation in the Middle East. Maybe it's resolved tomorrow, maybe not. However, when you have a spike in oil like we've had, it impacts, it's not just the price, it impacts the supply chains, it impacts a lot of supply chains around the world. Even if you have a resolution tomorrow, it will probably take time to really see the true impact on the consumer. And so that's something we're keeping a very close eye on.
Wow, fantastic. Well, thank you very much, Lionel.
Thank you for having me.